This morning, the mood in the stock market is a little better. US stocks are expected to open higher, not because investors are excited, but because things did not get worse. That matters. It tells us the market is trying to steady itself. Before the market opened, everyone was watching two numbers: industrial production and capacity use. In simple words, that means, are factories working? Are machines being used? The answer is yes, but not fast. Industrial production is expected to grow just a little, only 0.1%, slower than last month. But over a full year, growth is still around 2.5%. So the economy is still moving forward. It's just walking, not running. Factory use is about 76%, almost the same as last month. That means factories are not working at full speed. But they are not sitting empty either. They are somewhere in the middle. Over the long term, US manufacturing is not as strong as it used to be. Global trade made goods cheaper, but it also weakened production at home. For now, government policy is helping the market. Some tariffs have been reduced. Leaders are focused on lower short-term rates, cheaper home loans, tax cuts, and more government spending. And because it is an election year, these moves support the economy and the stock market in the short run. But investors also know this. Over time, big budget deficits and inflation can become problems again. Housing is still weak, but there are small signs of hope. Home builder confidence is expected to rise a little. Not high, still far from past peaks. Homes are expensive. Mortgage rates are high. Affordable houses are hard to find, but home sales are starting to level out. Even one interest rate cut this year could help the housing market a lot. Looking at the week so far, this is the second full trading week of the year. The Dow is slightly down. The S&P 500 is slightly down. The Nasdaq is down a bit more. There is no clear direction, but there is a lot of movement. One reason for this is talk about capping credit card rates at 10%. Banks are worried. They fear people will borrow less, especially lower-income households, that could slow spending and the economy. Most investors think this idea will be changed later, but right now it is affecting market mood. Bank earnings this week were mostly okay, but JP Morgan disappointed investors. Some investment banking income was delayed, which pushed the stock down. This looks more like an emotional reaction. Wall Street is still mostly optimistic about banking this year. Technology stocks are not leaving the market. They are switching places. After strong earnings from Taiwan Semiconductor, chip stocks moved higher. But the bigger story is this. Money is slowly moving away from last year's biggest tech winners and into industrial stocks, value stocks, and smaller companies. The money did not leave. It just moved. Right now, the market is not falling. It is not charging higher either. It is pausing, taking in new information, and quietly deciding who leads next.